Let us continue with last in, first out, when, or also known as LIFO method. Yeah? When the LIFO method is used in conjunction with perpetual inventory system, the cost of sale is determined at the point of each sale based on assumption that the last costs acquired are transferred out first. The concept is opposite to the LIFO, whereby last costs acquired are transferred out first. Okay. For example, I'll give you a simple example, same amount, same items. Yeah. We start with a 10 unit of inventory at cost of $10. At cost of $10. Later on, we purchase another groups. We have purchased another 12 units of the inventory at cost of $11. So we have two categories of toasters. Purchased at $10, purchased at $11. So we have two groups of inventory. Okay. This is under LIFO. LIFO means last in, first out. First out. Yeah. Last in, first out. Later on, when you sold the item to your customer, 8 units. 8 units. You have to decide whether you're going to take the old one first or the new one. Under FIFO, you took the old one, but under LIFO, you need to take the new one. So, under LIFO method, instead of taking 10, we are taking it from 12. So, 12 minus 8. 12 minus 8. So, the 8 here, the price is $11. It's not $10, but $11. Our old stock remain the same. 10 multiplied by 10. Our new stock 12 now is only 4 units. So 4 times 11, 44. So this is the new, this is the old. Yeah. The difference between last in, first out and first in, first out is, you can see, under last in, first out, the new stock 12 is the first stock that we sold. We take it out from our business. Under FIFO, we take 8 from 10 units, whereby under LIFO, we take 8 from 12 units, the newest one. And then we purchase a new item, 15 units at price of $12. So now we have 3 categories of items. Yeah, the really old one, 10 unit. Okay, the new one that we just sold, 4 units, and the latest, newest one is 15 units. On 12th January, you sold 10 units of the toaster, 10 units of the toaster. And the last in, first out, we're going to take the last one, the new one, the last one that is 15. So I'm taking that from 15, I'm going to take it out 10. So the 10 here, the price is $12. $12. So the balance of your inventory will be 10 remain unchanged, 4 remain unchanged, 5 minus 10, that give you 5. So this will be your new balance, new balance of inventory. So this is the method, what we call as last in, first out. Last in, first out. Let me explain again about last in, first out. Under this method, okay, we need to take out the last stock that come into our warehouse. So when we sell 8 units of this toaster to our customer, we need to choose. Which stock that we should take out. Okay. So we have 2 options. The first one, this is the new one. This is the old one. Sorry. This is the old one. This is the new one. So under last in, first out, we are going to take the 8 unit from the last stock come in. That is 12 minus 8. That's why our stock now become, our balance now become 4. Become 4. Become 4. So this is for the first one, yeah. So the cost of sales will be 8 multiplied by 11. 8 multiplies by 11, that is 88. Okay. Another example here for 10 unit of stock sold to your customer. We have 3 options. This is the old one. This is the first one. First, second, this is your latest. So from this 10, I'm going to take 10 units of stock from the 15, from the $12 unit stock. So it's going to be 10 multiplied by 12. So this is our cost of sales. Okay, and your balance, the new balance will be the 10 remain unchanged, 10, 4, 5. Okay. Let me test you one more, yeah. If you sell another 10 units, what will be the cost? 10 units. Can you help me? Which one we should take first? We're going to take 5. The first one is the new one. 5 multiplied by 12. So I'm going to take this one first. 5 minus 5. Still not enough. So I'm going to take the second one. 4 minus 4. 4 times 11. And finally, I'm going to take 1 from the last one. 1 plus 10. So what is my balance now? 9 plus 10. 90. So this is the stock balance. Okay, hope you can follow me on this. So last in, first out is when you sell the item to your customer, you are going to calculate the cost of that stock based on the latest. 9. Okay, there's one question. Why it 9? This is just additional. This is additional example. Yeah? Additional example. If you sell 10 items to another group of customer, so you are going to take the new one first. 5. I need 10. So I'm take this one 5. Take this one 4. And the last one, I'm going to take the old one 1. Okay, what is your balance of stock now? 5 minus 5, 0. 4 minus 4, 0. 10 minus 1. So your balance will be 9. 9 will be your balance. The cost is 10. So it's going to be 90. This is additional examples. So you're going to choose the first one, the old one, the latest one first when you take out the stock. Okay, so this is under last in, first out method. Last in, first out method. Okay, let us move to the next one. That is moving average method. This is more complicated. You need to have a calculator to do this. The average method is called a moving average because a new weighted average cost is calculated after each purchase rather than simply calculating a weighted average at the end of the period. So we need to calculate the average cost every time we do purchase. We do a new purchase. We do new purchase. Every time we purchase item, you need to calculate the average cost of inventory. The moving average method calculated after purchase is used to calculate the cost of sale and inventory on hand until additional units are acquired at different unit price. Every time you buy the stock, every time you purchase the new item, you need to calculate your new average. That is why we call it as moving average methods. Okay, this one is in terms of the table. You can see it's a bit simple, but you need to calculate the difference there. Okay, this is our cost. Originally 10 unit. The unit. The cost per unit is $10. So the total value for our inventory is $100. So this $100 is for 10 units. Later on, you purchase additional 12 units at price of 11. So now the price 12 times 11 is 132. Okay, the old one you have 10 multiplied by 10, that gives you 100. Then you buy a new one, 12 times with 11, that is 132. So the total cost for that inventory is 232. And this 232 is for 22 units. 22 units. Okay. Can you determine what is the average cost per unit? So the average cost will be 232 divided by 22. So this is your average cost. Average cost. So to do that is your total is 22. The total value is 232. So the average cost is 10.55. 10.55. Got here? 10.55. So that is the new average cost. You have to calculate the average cost every time you make a purchase, not sale. Every time you make purchase, you need to calculate the new average cost. Why 12 times 11? Because this stock, you buy a new one, 12 units, but the price is no more $10. The price is $11. So that's why you have 12 times 11. 12 times 11, 132. The first group of asset, yes, you purchase at $10. Second group, that is 12 units, you purchase at $11. So total you have 22 units, and the total cost is 10 plus 132. 10 and 132. Okay. So in a simple word, I can say that you have 22 units. One unit is 1055. That is why you have 232. Later on, you sell 8 units to a customer. Okay. You sold 8 units to a customer. 8 multiplied by 10.55. So the value, the cost of sale is 84. What is your balance? You have 22, sold 8 units, so the balance is 14. So the balance is 14 unit. The average cost is the same, 10.55, and this will be your new balance, new value for your inventories. New value for your inventories. Okay. What is your inventory now? 14. Let me just do the calculation here. 14 multiplied by 10.55. So you have 147.60. Okay, this is your current balance. Then you purchase another 15 unit at price of $12. So you purchase another 15 unit at price of $12. That gives you $180. What is the total value of your inventory now? 6072,327.60. What is the number of unit? Number of unit is 29 units. Oops, 29 units. Okay. Okay. Now, when every time you purchase the item, you need to calculate the new average value for the unit cost. So it's going to be 327.60 divided by 29 unit. 327.6 divided by 29, that gives you 1130. 1130. So this is the new cost per unit. 29 multiplied by 1130, you will get 327.60. So that is your new cost. And then when you sell the item to another customer, 10 unit, multiplied by the average cost 1130. So the total cost of sale will be 113. 29 unit, you sold 10, so your balance is 19. Your balance is 19. What is the cost per unit? 11, 11.30. So overall, the value of your stock now is 214.6. If you look at this table, it's a bit easy compared to the LIFO and FIFO, where when you calculate the average, you don't have to determine whether this will be the old or the new stock. This is the old or the new stock. You don't have to do that.